Hi everybody. In this video, let us discuss about some short-term sources of finance. In the previous video, we have discussed about long-term sources of finance. As I told you earlier, on the basis of time period, sources of funds are classified into three, that is long-term source, short-term source and medium-term source. So now let us discuss what are the different short-term sources of finance. So short-term sources of finance or funds include trade credit, bank credit, customers advances, installment credit, loans from cooperatives, indigenous bankers, factoring, accrued expenses, deferred incomes, commercial papers, letter of credit, public deposit, etc. And let us see what is trade credit. So trade credit refers to the credit extended by the supplier of goods in the normal course of business. Generally, suppliers grant credit for a period of 3 to 6 months and thus provide short-term funds to finance current assets. In India, buying goods on credit is a normal feature in many areas of business. Unless credit is extended, business cannot be made. So, the availability of trade credits depends upon various factors such as nature and size of the firm, policy of the suppliers, prevailing economic conditions, status of the firm, etc. And the trade credit may be allowed in shape of open account of bills payable. So, as we all know that if the trade credit means it is the credit extended by the supplier of goods in normal course of business. So, if the supplier is telling that you can take the goods from our company and you need to pay the amount only after a few years, then we can say that is a trade credit. And the next one is bank credit. So on bank credit, bank is providing different credits like cash credit, overdraft, purchasing and discounting of bills, loans and advances, etc. So as we all know that cash credit means it is the common form of financing for meeting working capital requirements. Banks consider firms' sales and production plans to sanction a particular working capital limit. So the limit is called the cash credit limit, and during the period of cash credit, the borrower can withdraw, repay and again draw amounts within a sanctioned limit. So thus cash credit refers to an arrangement whereby the banks allows the borrower to draw money from time to time within a specified limit. The cash credit facility is granted against the pledge or hypothecation of stock or pledge of marketable instruments, etc., or personal security. In short, we can say that cash credit means it refers to an arrangement whereby the bank allows the borrower to draw money from time to time within a specified limit. And overdraft, as you all know, it is a special facility or it is an advantage enjoyed by the businessman alone. So in bank, it is the arrangement whereby bank allows the customer to overdraw from their current accounts within a specified limit, and this is a temporary arrangement, and overdraft is granted against the security of assets or personal security as in case of cash credit, and interest is charged for the amount utilized. And the next one is purchasing and discounting of bills. And purchasing and discounting of bills, when goods are sold on credit, the suppliers generally draw bills of exchange upon customers who are required to accept the same. The term of such bill of exchange may be 3 to 6 months, and instead of holding the bill till the date of maturity, companies generally prefer to get them discounted with a bank. And discounting bill of exchange refers to the act of selling a bill to obtain payment for it before its maturity. So in short, we can say that it is the act of selling a bill to obtain payment before its maturity. And this is a form of raising short-term source of finance. And next is loans and advances. So loans and advances, as we all know, loans, when a bank make an advance in lump sum against some security, it is known as loans, and it also receives some advances from banks. In case of loan, a specified amount is sanctioned to the customer. the entire loan amount is paid to the borrower either in cash or by credit to his account. And a loan may be repayable in lump sum or in installment, as you all know about loans. And next one is customers advance, and some business or houses, they get advances from their customers against orders. So this is for short-term raising short-term source of finance, and the availability of advances from customers depends upon various factors such as type of goods, elasticity of demand, credit worthiness of suppliers, etc. So the companies will be receiving advances from the customers if they are giving any orders to the company. Okay, so that is a form of raising short-term finance. And next is installment credit. So as we all know about the term installment credit, they will be companies will be purchasing the assets for installment, and they will be paying the amount by taking few years only. So this is a form of raising short-term finance, as that does not require to pay the amount in a lump sum manner. That amount can be utilized for some other purpose, and they need to pay only on the basis of installment. So this is a type of raising short-term source of finance for working capital. And some cooperative banks are also providing loans, as we all know that, as like commercial banks, some cooperative banks are also providing loans and advances for in order to start business organizations, or in order to run the business organization. They are giving personal loan as well as business loans also. And indigenous bankers, they are also providing loans to the business organization in order to run the business activities. And another one important one is factoring. So factoring is also a form of raising short-term finance. Factoring means it is a process of selling the receivables by the firm at a discount to a financing organization, that is the factor. And the cash from the sale of the receivable provides finance to the selling company, and out of the difference between the face value of the receivables and what factor pays the selling company, it meets its expenses, and the balance is the profit of the factor for factoring services. So factoring is also a source of providing finance receivables. It also facilitates collection of receivables. It simply refers to selling the receivables by a firm to another party. Okay, and the buyer of the receivable is called a factor. And in short, we can say that factoring is agreement in which the receivables are sold by the firm to the factor, that is a financial intermediary. Okay, so the factor can be a commercial bank or a financial company. When receivables are factored, the factor takes possession of the receivables and generally become responsible for this collection. And it also undertakes administration of credit, that is credit control, sales, accounting, etc. Okay, in short, we can say that, or in sum total, we can say that it is an agreement in which the receivables are sold by a firm to the factor or a financial intermediary. The receivables received by a firm, in turn it refers to the client. So the client to the factor, that is financial intermediary. Okay, so factoring is another source of raising short-term finance. So these are some of the important sources of raising short-term finance, and it also includes some accrued expenses and also deferred incomes. Accrued expenses means, these are the expenses which have become due but not yet paid, and deferred income means it is income received in advance before supplying goods and services. And commercial papers and commercial deposits are also used for raising short-term source of finance. Thank you for listening to me.